Okay, chapter 4 is on the long-term assets. Last time we saw about financial reports and different sets of financial reports that you have to prepare if you become an accountant, or you have to read when you become a user of accounting information. So the first statement that you're going to see, that's an income statement, which starts with revenue, expenses, and finish with the net income. Then the next statement is the shareholders' equities statement, with why that's the second one, because the net income that comes from the income statement is going to go to retained earnings, which is part of the shareholders' equity statement. And on that statement, you're going to see what's the change in the equity, or what's the change of the ownership during the period, or what kind of changes that happen. Obviously, the contributed capital always going to be there. The only question will be, did we get retained earnings? Means, did we generate income last period, which is going to come as a retained earning? And did we deduct any dividends? Once we figure out how much is the equity, then we're going to focus on the balance sheet, and we're going to see what are the assets, liability, and equity in the company. Always keep in mind the assets has to be equal to liability and equity. Always keep that in mind. And then you're going to figure out how many assets we have, what's our liabilities, and once you figure out liability, then you're going to see what's the net assets, or what's left for the owners. In other terms, what's equity. This chapter, we're going to focus on one of the assets, not the short-term assets, the long-term assets. The long-term assets that give increase the value of the company and give the company ability to sustain for the long period of time. So let's see this. What's this about? There's some learning objectives here. We're going to identify the various type of long-term assets. We're going to explain the property planning. We're going to identify the factors, describe the implement changes of the depreciation. We're going to see what the depreciation is and explain accounting treatment, some other stuff. So let's go first. We have a different long-term assets in the company. Based on the term and based on the life. We're going to see there's a property, plant, and equipment, and when we say property, plant, and equipment, that including everything which is tangible, means to have a physical presence, which include land, building machinery, equipment, computers, and everything like that. Then we have the rights of use, which is also tangible asset, which can be leased by the company for the period of 1 year or more. And then we're going to have all this category of intangible assets, which will be the assets without physical presence. Goodwill is another long-term asset, and which goodwill comes from the purchasing a business. When we combine two or more businesses, we're always going to have a goodwill. And the last thing is biological assets. Biological assets, I don't mean employees. We're talking about the living plant and animals. Now, why the long term is significant? Because if the company wants to stay for the long period of time to sustain for the foreseeable future, it has to invest in the long-term assets, because those long-term assets are the one that's going to generate that future revenue. So we have to purchase and sell. We can purchase and sell the long-term assets. And those are the most significant investing activity in the company. So from where the cash is going to come? Cash always going to come when we sell the asset, and we have to spend the cash. Outflow will be when we purchase the asset. Now, the most of the assets are subject to depreciation and amortization. So what's happening here? When the assets, long-term assets, we're dealing only with the investing activity as part of the cash flow statement. So cash going to purchase the long-term assets, and cash can come from the proceeds once we're selling the assets, whatever we get. Since the assets represent future economic benefits, we have to value that assets. Why is the future economic benefits? Because generates revenue through the sales over the long period of time, and at the end can be sold or not sold. So we have two methods, two models on the International Financial Reporting Standards, the standards that govern the public companies. Under that method, we have cost model, which only model allows is the country standard for the private enterprises, and we have this revaluation model as well. So let's see here the cost model. Under the cost model, those assets is going to reflect their carrying amount, or how much they're currently on our statements of financial position. So for that reason, we have to do two things. First, we have to have always how much is the original cost of the assets and how much we expense over the useful life of the asset. Now, what will be the carrying amount which we're going to stay on the financial statements? First will be the original cost less any depreciation or impairment loss that we might have over the life of the asset when we're using the asset. And this does not necessarily represents the asset, how much the asset is the current market value. So how it's going to work? We're always going to carry the account for the asset here, and which account with the asset always going to go together with accumulated depreciation for that particular asset. So the cost minus the accumulated depreciation that we already take for using the assets, it's going to give us that carrying amount. The question is, so now we have problems, right? We have to identify what's the cost, and then we have to measure somehow how much depreciation we have to transfer over the life of the asset every single period. Cost. Let's focus on the cost first. Cost will be the cost that we not gonna expense, we're gonna carry with us on the balance sheet. So that means we're gonna capitalize it. Every time when you see the word capitalization, means carrying it in the balance sheet for the long period of time and slowly reduce the value with also depreciation. So what will be the cost? First, we have to include the purchase price. You're going to have assignment for this, so you have to be careful with this. What to include on the cost, what the cost is comprised. First is again the purchase price, and deduct any rebates that you may have from the government or from the purchases that you're getting the asset, and any discounts. Then what you have to add is any taxes and dues that you have to pay, which later you cannot claim and refund them. So if there are any taxes that will be not refundable, you have to include it in the cost of the asset. Any import dues and anything like that, you have to include it. Legal cost associated with the purchase also has to be included. Shipping costs and transportation costs has to be included. Site preparation, installation, and setup costs for the machine, for the equipment, for anything that you're purchasing, it has to be included as well. So how you should look at this? You should accumulate the cost of the asset until the asset is ready for use, for intended use of the life of the asset. So Whatever you purchase the assets for, once somebody says, yes, you can start using it, any cost up to that point, it has to be capitalized and has to be carried as a cost of the asset. Let's see this example. Now, let's assume that the company purchased a new warehouse for $2.4 million. As part of the purchase price, the company also acquired land that the warehouse is going to sit on, warehouse building, and some fencing around the property, some storage like. So in this case, company has an appraisal. They hired somebody to estimate the fair market value of all the components, and they come up that all the components were for $2.6 million. Now, as you can see, the buyer were able to purchase all those things. So we have land, we have the warehouse, we have fence, we have storage risk. And we purchase all those things for 2.4 million. Their market value is 2.6. So I guess, obviously, we negotiated a very good sales price. Now, since every asset has to have his own amount of this 2.4 million that we paid, so now we have to allocate the 2.4 million over the assets, which market value is 2.6. How we can do this? We're going to use the proportionate method. What's the proportionate method? The proportionate method you can look at this point. I'm going to move to the Excel spreadsheet. And I can explain it there way more easier rather than sitting on the slides. Just give me a second to prepare one Excel spreadsheet, and we're going to start working. I believe one of those things you have to prepare for your assignments as well. So that will be useful for you to understand how exactly you can allocate the cost So what's happening this, sorry, that's not the one that I intend to do. I just want to share this one with you. So what's happening in reality? We pay in total $2,400,000. That's how much we paid. Then we see, okay, we paid, what we purchased for those $2.4 million, we purchased land, we purchased building, which we purchased storage racks, and we purchased fencing. At the time of the purchase, once we get the documents, when all the sales deal is done, we get somebody to evaluate the assets, and the evaluator come up with these values for every single asset. So he said, you know what, the fair market value of the land is $1.3 million, the building is 9.10, the storage rack is 2.6, 260,000, and the fencing $130,000. Total, all the assets that you purchased for $2.4 million, they actually worth right now $2.6 million. So if you sell those assets right away, we're going to make $200,000. But we're not intending to sell them. We're intending to use them. In order to use them, we have to put them on the balance sheet, recorded on the balance sheet. But now we have a problem. How can we allocate cost of something that was $2.6 million for the cost that they paid $2.4 million? Well, in that case, we're going to use the prorated method or percentage. What we're going to do, we always know that the total price that we pay is 100%. That's our starting point. What we paid is always 100%. Now the question is, what's the percentage of the land out of 100, building out of 100, storage rack out of 100, and fencing out of 100? That will be easy to calculate. Get this value divided by the total value, and we can easily see what's the percentage amount of all those. Once we combine those together, they're supposed to give us 100%, and they give us 100%. That's your proof here. So now we know what's the percentage of every single asset, which total value is $2.6 million. By knowing that, and we knowing that we pay only 2.4, let's find out how much cost of the 2.4 we should allocate it to the land, to the building, to the storage rack and fencing. So we're going to apply the percentage, but this time we're going to apply it to the purchase price, not to the total. And we're going to get 50% of purchase price should be allocated to the land, or land we should record it as $1.2 million. We're going to drag down, and we're going to get the rest of the assets. The total should be always equal to $2,400,000, the amount that we paid. And that's how we allocating the cost for our assets when the purchase price is different than the fair market value. So now you're going to ask me, what if those values are low? Is it possible the fair market value instead of 2.6 to be lower? Yeah, it can be lower, but it can be higher. So what's going to happen if, for example, if the land worth $1.5 million? Well, in that case, we have to adjust everything. We have to adjust so first thing that we have to adjust is we're going to get our total. Now our total is $2.8 million. Now, how this is going to affect our calculation? Well, our percentages that we are allocating for every single asset is going to change. But at the end of the day, once we allocate the cost and once we make a record for our assets, the total amount will be the amount that we pay cash or with the bank transfer, whatever we pay. Make sense? I'm going to stop sharing this and then let's go back to the slides. What will be some consequences after we purchase? Subsequences after the purchase is we may have something, we may add some cost, which can improve and make the asset better so it can be used for the longer period of time. Or we may have some cost that we can simply expense. Which will be the cost that we have to capitalize or add to the cost of the asset is only the cost that improve the asset and extend the useful life of the asset. Which are the expenses that we're going to treat it as an expense and as a period cost? That will be anything which is related to maintenance of the assets to the intended purpose. Revaluation model, so that was the idea with the cost model. When we have cost model, let's see a revaluation model. A revaluation model, under this model, those assets, which is property, plant, and equipment, are carried at the fair value, less any subsequent accumulated depreciation and subsequent impairment loss. Now, the revaluation date is usually every year or every 3 or 4 years. That will be based on the management, and that will be based on the current economic conditions. If the company using this method for a class of assets, then all assets must be reevaluated. You cannot apply this only for one type of asset. Depreciation. What's the depreciation? Depreciation is if the cost is capitalized, then there will be expense in the future as a depreciation expense. So every time when we purchase the assets, which we're using to generate income, we have to transfer that cost into the expenses asset depreciation because the value of the asset depreciates. In order to come up with the depreciation, we must know the following. We have to know the cost, we have to know the estimated residual value, and we need to know the estimated useful life. Cost always going to be the final cost of the asset, including shipping, delivery, insurances, restoration, anything that makes the asset available for use for the intended purposes. Then we're going to go with the estimated residual value. That will be the value that management assume that can get at the end of the useful life of the machine or the equipment or the property. And then we're going to go the estimated useful life. Estimated useful life, management has to determine in terms of years, in terms of kilometers, in terms of hours, whatever they decide, for how long we can use that asset. Then we're going to come up with the depreciable amount. That depreciable amount will be the cost minus the estimated residual value. Now, how many methods of depreciation we may have? We have three. There might be more, but let's go with the most common depreciation method. First one is the straight line method depreciation. When somebody tells you straight line, that means every year we're going to take the same amount over and over and over again. Unit of production method is we're going to use the unit of activity, or how many units this machine produce over the number of the units the machine produce. That will be our driver for the depreciation. And the last one is the diminishing balance method, which also is declining balance method, which means is we're going to start taking amount, and every time the balance of the asset is going to go down. So we're taking the same percentage, percentage. So that means that slowly, we're going to decline the balance of the machine. Each method is going to produce a different depreciation expense. Straight line method, it's going to be same amount year over year. Unit of production will be always depends on how many units we produce, so may fluctuate. And the diminishing balance is in the beginning of the useful life of the asset, in the start of the asset, we're going to have a huge amount, which amount slowly is going to start getting down. In reality, all the three methods should produce the same result, starting at the same point and finish at the same point, which the same point will be the original cost minus the residual value that we estimated that we can get from the asset. Let's see one example. This is the example that we're going to work. So let's say a company buy equipment for $50,000. Management determined that the equipment has the estimated useful life of 5 years and estimated residual value of 5,000. Company has December 31st year end. So that will be our starting point, and I'm going to get this one in the one Excel spreadsheet. That will be our question, and then we're going to see how we're going to extract the information for that question. So, first method will be straight line method. For the straight line method, let me paste this slide as well. Now I can shift my screen and share with you the Excel spreadsheet. So what do we need to know here? First, what we need to know is what's the cost of the asset. Second thing that we need to know is what's the residual value of the asset. Once we get those two, our life will be way more easier. Obviously, cost of the assets. First, what we purchase? We purchase equipment. What's the cost of the equipment? $50,000. Then we have to see what's the residual value. Residual value, you may also see it as an abbreviation of RV. Residual value in this case is $5,000. So at the end of the useful life of the machine, we're expecting to get $5,000. And the question is, if for something that we pay $50,000 and we expect to use it for 5 years, and at the end of the 5th year, we're going to get $5,000, how much we have to depreciate over the useful life? Well, depreciable amount in this case will be the difference between the original cost and estimated residual value. So our depreciable amount in this case will be original cost minus residual value, or $45,000. $45,000 we have to depreciate it equally over 5 years, because we know that the useful life of the machine is 5 years. How can we do that? Very simple. Every year we're gonna reduce the value of the asset with the same amount. So in year 1, so let's see if we have to prepare the amortization schedule, how that amortization schedule is gonna look for us. We bought the machine, that will be the years is the first one, and we bought it 2024, and then we're gonna 2025, and we need to have 5 years, 1, 2, 3, 4, 5 years. So we're gonna depreciate this machine all the way to year 2028. Now the question is, what will be the balance in the very beginning? At the very beginning, we purchased the asset for $50,000. So beginning balance is $50,000. Now we have to estimate how much we're gonna depreciate every year over 5 years. So if our residual value is 45,000 and we have to use the asset over 5 years, our annual depreciation would be 45 divided by 5 years and keep it the same amount, $9,000. And we're gonna have our depreciation expense. Let's make it useful like this. Once we have the depreciation expense, once we deduct, we're gonna have accumulated depreciation. And the last thing that left is ending balance. Ending balance. Once we have those, we can complete our formula. Depreciation expense always will be the annual depreciation. Accumulated depreciation in the beginning, at the very first, when we purchase the assets. Let's see of the year 1, year 0, that will be year 0 of the purchasing the asset. Our balance we purchased for 50,000. That was the purchase price, which is equal to 50,000. Now the first year we use it the entire year. The depreciation expense was $9,000. Accumulated depreciation at this point, since we started was 0, now it's going to be equal to 9,000 plus that 0 from before, so it will be 9,000. And our ending balance at the end of the first year, we're going to be, since we purchased on January 1st, it's going to be beginning balance or ending balance minus the $9,000 of depreciation. It's going to be 41. What's going to happen next year? Next year is going to be very simple. We're just going to drag this one down and we see going to happen. That should be equal to this one, and that's going to stay the same. Once we do the schedule, what we're going to see every year, our balance from the beginning and the end balance is going to go down with $9,000 until we reach year 5. And at year 5, our ending balance is going to be equal to our residual value. So over the life of the useful life of the machine, we're going to depreciate the $45,000, which is our depreciable amount, which is equal to our accumulated depreciation. And that's always going to be your check. Don't forget, at the end of the period, once we start finishing machine, we have to have the residual value sitting and waiting for us as a balance. We cannot go below the residual value. That will be the straight line method. What's the interesting with the straight line method? Every year we depreciating exactly the same amount, year over year. And we're not changing that amount. Let's mark it with blue. No, that's too like this. So let's use this example and let's see what's the other method. The other method is called unit of production method. So for the unit of production method, we're gonna need a little bit more information. Let's name it this straight line method. And the next one will be unit of production. Unit of production method. For the unit of production, we're still gonna work with the same, but we're gonna do some modification on our Excel spreadsheet. What will be the also modification? Because the economic benefits now of the assets are related to the units of use, we have to come up with a new idea how exactly we're gonna drag that depreciation expense. Obviously, it's not gonna be over the number of years. It has to be related to the driver to our depreciation expense. And what will be the driver for our depreciation expense in this case? The units that these assets produce or expected to produce over the useful life. For that reason, we need a little bit more information. And here they give us this chart, interesting chart, which they're saying that this machine over those years, let's put it somewhere right here. Over those years, units per year that this machine can produce is in the first year, 2024, it can produce 4,000 units. Next year, 25, 5,000 units. Next year, 2026, can produce 6,000 units. Next 1 year should produce 4,500, and the last year, 3,000. So once we have the number of the units, what do we need to do? Is very simple. We have to find out first how much is the total. Once we find out how much is the total, 22,500 units. So over those units, we have to depreciate the $45,000. So our annual depreciation per unit will be equal to depreciable amount divided by the number of the units that we're going to produce over the life of the machine. Or every time when we produce a unit, we have to transfer as a depreciation expense $2. So we have to do slight modification in our chart here. In order to get the depreciation expense, we have to insert a new line, new column, which new column we're going to call it units produced. Production. Units of production. So we have our units of production. What we need to do is just to plug those units. And that will be number here, not dollar amount. So our depreciation expense will be equal to units of production times depreciation amount per unit, or 4,000 times the $2 per unit that we calculate. So the first year, our depreciation will be $8,000. Second year, our depreciation will be $10,000, $12,000, $9,000, $6,000. So as you can see, once we complete those units at the end of year 5, this one will be 1 year, 2 year, 5th. We're going to transfer as a depreciation exactly the same amount, which is the depreciable amount of $45,000. How much will be our accumulated amortization? Depreciation in this case will be this one plus that one. So at the end of the year 5, our accumulated depreciation will be exactly the same amount, $45,000. Ending balance should be equal to the residual value, always, regardless which method we're using. And that will be our schedule for the units of production method. Now, the last method that left is the declining method.
Sir, how did you get the depreciation expense?
Depreciation expense again is equal to the unit of production times depreciation per unit that we calculated right here.
Thank you.
Right. Units of production times the depreciation per unit, it's going to give us the depreciation expense. Right. So what I can do is I can put some shapes here. Can help you. So this one times that one, it's going to give you that. Or to make it easy, I can insert here one column, and I can put here that will be depreciation per unit. And that will be more clear. Depreciation per unit is equal to $2. This one, let's lock it, and then we'll be fine. And that's how we get it. I believe that's more clear, right? Correct? Okay, so we get the depreciation with the depreciate, sorry, that will be the whole thing will be, now we have to delete this one, let's delete this one because we modified, that will be our units of production method. And the last thing that left is the declining, double declining method. So let's go with that method and see what's the interesting with that method. Obviously, again, we have to do some modification in our table. So let's get rid of this first, and let's get rid of this. And we don't need the units of production, so this information is not needed for our purposes. We're gonna need a different information now. Let's get, I'm gonna get quickly from the slides information about the declining method. I'm trying to find here. We have to, in this method, for this method, we have to come up with the percentage before I go. Greater portion of the assets, so basically that will be the slides related. Let me post it as a picture right here. So for this method, we're going to use the percentage. Now, question is, how are we going to get the percentage? How it's possible to come up with the percentage? It's very simple. We have the useful life of the machine, right? One divided by useful life of the machine is going to give us percentage. So technically, every year, if we transfer 20% of the assets of the cost, we're gonna depreciate our asset. Because time 5 years times 20% is gonna give 100%. Now, depends on which method we're using. Depends on which method we're using, then we're gonna need a multiplication number. So let's say if we're using double declining method, then we have to multiply 20% times 2. So our depreciation percentage, depreciation rate, in this case that we're going to apply, it's going to be depreciation. Our depreciation rate in this case will be equal to the percentage that we come up times the multiplication rate, which is 2, and our rate will be 40%. And that will be the rate that we're going to apply in our calculation to come up with the depreciation expense. Make sense? So now, what if, so here first, again, you have to get the formula, which is 1 divided by the number of the years. Once you get that one, that will be most likely here, then you're going to get the multiplication rate, which is the double. If it's double, apply 2. If it's triple, apply 3. And then you're going to get the depreciation rate. With the depreciation rate, depreciation rate will be the one that we're going to apply to our balance. And once we apply that rate to the balance, we're going to get our depreciation expense. Let's get rid of those. And that's how we're going to get our depreciation expense. Accumulated depreciation, always going to be calculation of the depreciation expense current year plus the year before. So let's apply. Our rate here is equal to the rate that we calculated, 40%. So first year, we're going to apply that 40% to the balance, beginning balance of 50,000 times our depreciation rate, which is 40%. First year, we're going to take 20,000. Actually, here now the depreciation rate actually is going to be equal always to this one. And then the depreciation expense here, sorry, the depreciation expense will be this amount time that amount, and we don't have to log the cell, 20,000 first year. So the 20,000 depreciation expense is going to bring the balance to 30,000. 30,000, we're going to apply 40% again. That will be 12,000. That's going to bring our balance to 18,000. 18,000 year 3 starts. We're going to apply the 40%. And then our ending balance will be 10,800. 10,800 in year 4. We're going to apply again 40%. And that's going to bring our balance to 6,480. Last year, we're going to year 5. We're going to start with 6,480. We're going to apply 40%, and that's going to bring us our ending balance to 3,888. But we have a problem. That ending balance should be equal to residual value. So, is this number equal to our residual value? No, it's not. So now we're in trouble. What shall we do? Last year, when we applied the double declining method, we literally manually have to adjust the interest depreciation expense in order to reach our residual value. So whatever the formula here you're using as a percentage, you have to ignore it and bring it manually to the $5,000. So how much will be the depreciation that we have to take on the balance 6,480 in order to bring it to 5,000? Well, obviously, you can easily do it this amount minus the residual value, and it's going to give you the amount. In that case, and only in that case, your residual value will be equal to the residual value we estimated, and the total depreciation expense will be equal to the depreciable amount that we have to depreciate over the life of the asset. Now, this adjustment is done only and only under the diminishing balance method, which can be double declining or triple declining, whatever method you decide to use. So if we have to compare all the three methods, if we have to compare them, let's do one quickly comparison between all the three and see how much each of them give us. So if we use this, if you're using the straight line method, our depreciation expense will be here. I don't need any of those. And I don't need this, and I don't need this, and I don't need this. So for the straight line method, sorry, I have to copy it again. That will be our allocation. That will be our numbers. and the total will be $45,000. If we're using the depreciation expense under the, that will be we can easily do it this way, match those one depreciation expense. And first one is the straight line method. Second one is the units of production. And the last one is double declining method. Let's compare all those three methods and see what's happened and which one give us the highest depreciation expense, which is kind of tricky question because technically all the methods should give us the same amount. But let's see if that's actually true. If we compare from the units of production, that was our depreciation expense year by year. And the total is exactly the same. And double declining method, on the double declining method that we use, these are our numbers, which give us exactly the same. Why is exactly the same? Because all of them has to be equal to the depreciable amount. And all of them give us the balance of $5,000, which the residual is represents the residual value of $5,000. All of the methods give us the balance of any balance is $5,000. $5,000 under the straight line, $5,000 under the units of production, and $5,000 under the double declining method. That will be should be the total amount. And that $5,000 is all across the board. So what's the difference between the methods? The only difference, as you can see, is the annual depreciation that we're applying over the years. That's the only difference. And so as you can see, is on the straight line method give you the exactly the same amount year over year. Units of production fluctuate year over year. And the double declining method is start with high and finish it low. But again, all the three methods gonna give you the same total. And under all three methods, you have to have the same residual value sitting and waiting for you as a balance in the account. Can I explain again how did I arrive with the 40%? Yes, I can explain again. So first, let's say the useful life of the machine is 5 years. Now we have to come up with the percentage. We're gonna use the simple trick. 1 divided by the number of years is gonna give us the percentage. What's the percentage of the depreciation that we have to take every year, or what's the proportion of 1 year over the useful life of the years? You can put it this way. So every year, if you take 20% of the value, at the end of the 5th year, you're gonna take the entire value. So that's how we come up with the 20%. Now, because we want to accelerate the depreciation, we can use double declining. If you want to accelerate it even more, we can use it triple declining. If we're using triple declining, our multiplication, there's no change here in the useful life. We're still going to have exactly the same, but our depreciation rate, if we use triple declining, will be different. Will be 20% times 3. So now in that case, our depreciation rate will be 60%. So how we come up with the depreciation rate? The depreciation per year be calculated by the formula 1 divided by the number of years times the multiplicator, which accelerate our depreciation. It can be double decline. If it's applied to, we double it, the depreciation. If we want to triple it, we use 60%. And what's going to happen in that case? We can depreciate the asset faster. In the first years, you're going to have a huge depreciation. If you want to do it with the 60, what we can do is we can do one comparison here. We can apply a rate of 60 here. And the beginning balance, so the beginning balance is equal to $50,000. In that case, as you can see, at the third year, we're already below the balance. So what's going to happen in that case? We have to, here you have to adjust, at this point we have to adjust our depreciation minus the, the opposite way. That will be equal the 8,000 minus the 5,000. So in that year, our depreciation will be only 3,000. 5,000 is our balance, and here depreciation will be 0, and here depreciation will be 0, and that's how we're going to keep it 5,000 residual value. So as you can see, if we use the high percentage, like a triple declining percentage, we're going to amortize our asset over 3 years. If the price is highly sensitive and we're using the assets a lot in the beginning, we may go with the higher level of depreciation. But again, at the year 5, you have to have the residual value sitting and waiting for you. And the total depreciation expense that you can take over the useful life of the machine, it can be $45,000. Okay. Does that answer the question? I hope that answers the question. So now we have everything. We have the comparison. We have the average method. I even give you the triple declining method if you have to use it. You have the units of production, and you have the straight line method. All the methods in one. And of course, I'm going to post this one for you. This will be the allocation, cost allocation. Table. And I'm going to post to this Excel spreadsheet so you can have everything. Now let's go to the slides again and finish the slides. Where were we? We are right here. With the example, and we come up with the straight line method, and the straight line method, we come up with our depreciation per year will be $9,000. How we get the $9,000? We're gonna depreciate 45,000. 50 minus 5,000, 45,000 over 5 years. Or every year we're gonna take 20% out of $45,000, and we're gonna come up with the percentage, which is 9,000 every single year. Total accumulated depreciation will be $9,000. Carrying amount that we have on the beginning balance always will be the residual value. If we're using the unit of production method, we're gonna depreciate the asset over the units that we're producing. So we're gonna get the information about the assets produced during the period useful life of the machine. We're gonna get the depreciable amount divided by the estimated units that we can produce over the useful life of the machine. We're gonna come up cost per unit. So every time when we produce 1 unit, we're gonna transfer $2 to our depreciation expense. And if you're producing the units that we have scheduled, we're going to transfer at the end of the fifth year $45,000 to our depreciation expense. And the ending balance of the for that equipment is going to be $5,000, which is the residual value. Double decline or diminishing decline. Now we're going to take the great portion of the ACCT economic life in the beginning. So we're going to transfer more depreciation in the beginning and less depreciation later year. How are we going to get that depreciation rate? We're going to get 1 divided by estimated useful life of the machine. 1/10 or 1/5 or 1/7 depends on the year that we're using the machine. Then we're going to multiply the assets carry amount by the depreciation. Remember, the carry amount decreases every year. Depreciation price decrease each year. Common accelerated depreciation method is a double declining. How we get the 40% of the double declining is when we get 1 divided by 5, which is going to be 20% normal depreciation. If we want to double it, if you just for 20% times 2, and we're going to double the depreciation expense. So again, in our case, determine the depreciation rate, which we want divided by 5. Apply the rate to the assets carry amount, and ensure that the assets ending carry amount is greater than or equal to the estimated residual value. If not, then go to step 1. So our calculation will be 1 divided by 5 will be 20. We're going to double it because we're using double declining method. It's going to be 40%. Every year we're going to apply that percentage to our carry amount, and we make sure that the carry amount doesn't go below the residual value. In the year that that amount goes below the residual value, we manually gonna go and adjust the depreciation expense to match our calculation and to match the ending balance to be equal to the residual value. How are we gonna record depreciation? Very easy. Debit depreciation expense, create accumulated depreciation, and we are done with this. Now, what's going to happen if we have a partial period? Obviously, not always we're going to buy the assets on January 1st or February 1st. Sometimes we're going to buy it on January 15th or January 22nd. Well, in that case, what we're going to do is we can prorate it by days. That's one option. The other option is if you buy it on 10, assuming that you buy it on 15. If you buy it on the 26th, assuming that you buy it on the 30th. Right? In that case, you're going to have either half month, either full month. There's a rule for half-year rule for the tax purposes. So for the tax purposes, depreciation is not allowed. Canada Revenue come up with a new thing, which is called cost capital allowance. This is the only thing which is allowed by the Canada Revenue. So your depreciation expense is not allowed expense by Canada Revenue in calculation of your taxable income. So you have to come up with this capital cost allowance, which is similar to depreciation on the percentage rate. Corporate income tax. On the income tax method, now for the calculation of the corporate income tax based on the depreciation. Again, first, income tax specify exactly what the rate should be used. Residual value is ignored in this case. And the tax determines the maximum depreciation that the company can take. Can the company take lower than the maximums? Yes, they can. If they take lower than the maximums, are they going to lose the difference? No, they're not. They're going to carry it forward in the future. Can we change depreciation methods? Well, we might decide to change it, but if we decide to change it, we have to go back in past and change it for the past. And then we can apply the new depreciation method. That's example of the changing of depreciation method from, let's say, from changes in the useful life and residual value under the straight line method. Impairment. What's the impairment? Impairment is sometimes there's an event in reality that cause impairment on our assets. What's going to happen in that case? We're going to estimate the total of the future cash flow, which is expected to generate on the assets, and the asset fair value less the selling cost. If those are different, then we have impairment. Then we have to find the recoverable amount. The recoverable amount is greater of the total of all the future cash flow, which is expected from the assets, and the fair value less the selling price. Impairment loss will be expense, which is expense over the income statement. So again, what we're going to do, we're going to check the carrying amount. Then we're going to see which is greater, expected future cash flow or fair value less selling price. We're going to apply greater of those two. If the carrying amount in this case, if the carrying amount is less than the recoverable amount, we're okay. But if the recoverable amount is less than the carrying amount, then we're going to have that impairment loss. So we're going to bring the carrying amount to the recoverable amount in that case. Again, if the recoverable amount is greater than the carrying amount, no impairment. But if the recoverable amount is less than the carrying amount, then we have impairment loss. Example for impairment loss will be at the end of the year 2026, the carrying amount of the asset is 23,000. But management make the calculation and come up the recoverable amount of the asset is only 20,000. So you have asset on 23,000 in your books, which you can recover only 20. So you have a loss. Once you have a loss, you have to show it right away. And then you're going to debit the loss, which is going to go reduce your income, and accumulated impairment losses will be for the equipment. So what you're going to have? You're going to have now the equipment value, 50,000, less accumulated depreciation, 27. Now we're in the 23, and less impairment loss on the equipment, 3,000. It's going to bring the asset value to 20,000. What's going to happen when we decide to dispose the asset? Well, we have different types of disposal. One of these disposal is to scrap it, means stop using it. This means that we're gonna de-recognize it. There are two steps that we have to follow. First, before we de-recognize it, first we have to depreciate it up to the date of de-recognition. And at that point, all the asset and related accumulated depreciation has to be removed from the books. Once we do that, we may have gain or we may have loss. So what's going to happen? Since we stop using the asset, let's say the equipment original cost was 50,000. So far we use it and we recorded depreciation for 27. So we have to $23,000 of the value of the asset. We just throw it in the garbage. Well, that will be our loss. Why? Because we're going to stop using the asset. We're not going to use it anymore. So we're losing the opportunity to deduct depreciation from that asset For that case, all the balance is lost for us. Intangible assets. What's the intangible assets? Those are assets that don't have a physical form, a physical appearance. You cannot touch them, you cannot smell them, you cannot do anything. So the guidelines is if the asset is developed internally as a research, must be expense if it's a research cost. But if it's development cost, there's some criteria that has to be met. And if those criteria are met, then you can capitalize it. Means record it as asset. That's if it's developed internally. Can you purchase it? Yes, you can. Then acquisition cost will be the amount that you have to put on the balance sheet or capitalize. Those assets are initially recorded at cost, which both methods are allowed, and management must determine whether or not the asset has a infinite useful life or finite useful life. What means that infinite useful life is going to be used forever or can be estimated. What is the type of the intangible assets? We can have a trademarks and copyrights. If we have trademarks, then the legal life is the maximum for amortizing. Legal life is the one that we may use to assess the useful life. So the legal life in that case becomes the maximum for amortization. What means legal life is when you buy a patent, you have a contract which bind both parties for the usage of that pattern, and that pattern can be for 20 years. So the legal life, which is the legal agreement that you sign with the other party, become the legal life. And then the useful life will be equal to the legal life, which is 20 years of usage. Useful economical life is generally used for the calculation amortization. We may have the trade secrets, which has no legal registration system in Canada. Additional type of the intangible assets can be licenses, can be computer software, or can be development cost. Again, development costs, remember, it can be capitalized only and only if they meet certain specific criteria. If they don't, they're expensed. Research, never capitalized. How are we going to do the accumulated the journal entry for depreciation? Well, amortization expense, accumulated amortization on the intangible assets that we depreciate. Goodwill. What's a goodwill? Goodwill is simply the difference between the purchase price and the fair market value of something that you buy as a business. That's the tricky part. Goodwill is related to business. One business by another business. And then you may have the premium, which premium again is related to the purchase price versus the fair market value of all the assets of that company. Let's see, we're purchasing something for $2 million. We have the fair value of everything, of the land, of the building, equipment, inventory. Once you buy the business, you have to understand that you're not only buying the assets, you're also buying the liability as well. So we bought the liability $350,000 as well. So the total fair value of net assets, which is asset minus the liability, or in other terms, the equity that we purchase, is $1,600,000. So we have $400,000 difference. That will be our goodwill. Why we can have a goodwill? Because we see value when the other people don't see it. We're thinking that this business is going to give us something else. Is it going to be increase in the market share? Is it going to be increase in our personal shares? Either going to be access to the customers that we want, regardless what is it. But it's worth enough to pay $400,000 more. How are we going to carry the goodwill? Well, we're going to do that impairment, and every time when there's impairment, we're going to reduce the value of the goodwill. So the carrying amount of the goodwill always going to be the original goodwill, which was recognized at the date when we purchased the business, unless any impairment loss of the goodwill. Goodwill, what you have to remember, is not amortized, only impaired. Then we're going to have the right of use assets. That the right of use assets is all the assets that we keep it under lease. In other terms, rented by the company. A lease in the rental agreement gives the company rights to use the asset over the term of the contract. For that reason, for the time being, we are recording these assets as a right of use asset. And biological assets. What's a biological asset? Biological assets against living plants and animals, which biological transformation growth is managed. Example will be trees, grapes, wines, fishes, chicken, cows, blueberries, raspberry, you name it. Once it's harvested, biological assets become agricultural produce and eventually inventory. Those has to be recorded at the fair value less any estimated selling cost. How are we going to measure the age of the assets? That will be something interesting. That will be the total accumulated depreciation divided by the total assets less land. Why we're going to deduct the land? Because the land doesn't depreciate. Land is the only asset that doesn't depreciate. Average age will be the total accumulated depreciation divided by depreciation expense. And the fixed asset turnover will be the sales revenue divided by average net property, plant, and equipment. How are we going to get the average? Beginning balance minus the ending balance divided by 2. And that's your chapter. That's everything from the slides today.